So let's look at an empirical example, okay? And here we're trying to establish a floor price or minimum selling price, okay? And we know that the floor price is equal to the strike minus the premium. And if, as I said, if we add the basis, we'll subtract that basis off. So it's just a matter of adjusting it for the basis. So let's take an example of a farmer, okay, that has some soybeans. So that individual is long in the cash market. The cash price is $5.80. They look at May futures, they're at $6.20. They're also considering purchasing a put option as an alternative to selling futures contracts. So they look at the options market and they see this range of strike prices. And we discussed this somewhat on Wednesday as to which option do you choose. So this is I might ask you to decide which option to choose. It'll either be the most expensive or the cheapest, okay? And as I said on Wednesday, you buy the most expensive option, you're buying more protection, but of course if that option expires worthless, you would have been better off with the cheaper one, right? You follow that intuition, right? You're buying insurance, and so it turns out you don't need the insurance. You're better off if you had bought the minimum insurance. However, if it turns out you do need it, then you're better off with the more expensive insurance. So we look at these strike prices, and so we ask ourselves, well, what floor price do we want? Well, we take the strike minus the premium, and the basis is going to be constant here across strike prices. So we have some expected basis level. So here this is $6.25 minus 25 cents, so that gives us a floor of $6 minus our expected basis. If that happens to be 30 cents, this gives us then a price floor of $5.70. If we go up here, we have $5.75 minus our premium of 7, so that's $5.68. If we subtract the expected basis, that gives us a lower price floor. So the question is, which put do you buy? Do you buy the one for 25 cents or do you buy the one for 7? Well, there's no clear-cut answer here. When you're hedging with options, that's part of the decision making. And which one you choose might depend on different factors, such as what are your expectations with regards to prices, and how much protection do you want to buy? Just how risk averse are you? So if you're a hedger, again, let's think of Southwest Airlines, because this is what they do. They buy options instead of trade with futures contracts. When they're trying to decide which option to buy, clearly they're in the market so much, they have some expectation of whether oil prices are going to increase or decrease. So that might play a role if they have a strong feeling that prices are going to rise, a real strong feeling that prices are going to rise, then they might buy the more expensive option. But if they somehow feel that they probably won't rise or could even subside, but they still need some insurance, then maybe they buy the cheaper option, right? It's just like if you're driving around and if you know what sort of driver you are, and if there's a strong feeling, a high probability you're going to get in a car crash in the next year, well, you better have pretty good insurance, right? That's why I don't spend much for insurance, because I'm a little old guy who drives around Davis, and I don't ever exceed the speed limit. So I don't need much in the way of insurance, right? I really don't expect to get in a car crash. Knock on wood. So it really depends on your risk aversion and what your expectations are. So let's look at a couple of alternatives, okay? So we'll consider the most expensive or the cheapest. So there's a lot of numbers here, so let me take my time. But I do this so you don't have to write them down. You've got it in your reader there. So the most expensive is a $6.25, right? We saw that. That was 25 cents. The cheapest is $5.75. So let's start with this one, the $6.25. So our price floor is $6.25, right? That's the strike, minus the premium, right? Minus the expected basis. And let's set that at 30 cents. So our floor price is $5.70 as long as the basis is 30 cents, right? And you can see if the basis increases, it's going to be less than that. If it decreases, it's going to be more than that. So it's just like a short hedge in the futures market, where you long cash or short futures. Here we're long cash, we're buying a put. A decline in the basis is going to help this hedge. You can see it from that first equation. So if it goes to 20 cents, then our floor would be $5.80. So now that we've chosen the expensive option, okay, so this is one approach. We've chosen that option. Two things can happen, right? Price can fall, price can rise. Let's consider the impact. So first of all, let's suppose the price falls by 50 cents, okay? So all prices come down by 50 cents. So the futures price started out at, what was it, 620, right? If you look at the previous page, 620. So it goes down to 570. So our net return with a 50-cent price fall is 570. That's the new level on the futures price from 620 to 570. This is our basis, 30 cents, because we're still looking at this problem in an ex-ante sense. We think the basis is going to be 30 cents, but what if the price falls by 50 cents? Well, then our cash price is 570 minus 30, which is 540. We've paid 25 cents for the premium, so we subtract that 25 cents. And if the futures price happens to fall by 50 cents and it ends up at 570, then there's some intrinsic value, right? Let's ignore time value. Let's suppose this is the end of the last week of trading. So if the futures is down at 570, then there's the strike price was 625, correct? So we have intrinsic value of 55 cents. So we take our futures minus the basis minus the premium plus the intrinsic value, and we get 570. So our price floor was 570. If prices fall, we end up with 570. It's not a big surprise, is it? Again, I'm keeping the basis at 30 cents, and you can see if we increase or decrease how it will affect it. So possibility two is that prices rise instead of fall. So if they increase, and let's just bump them up by the same amount, by 50 cents, then the futures price goes to 670 from 620. The basis is still 30. We still paid 25 cents. The strike is 625, but the futures is now 670, so it expires worthless, right? Because we've purchased a put option and the price has risen, so there's no intrinsic value. It cost us 25 cents, so we end up with 615. So here we see one reason why hedgers are attracted to options. If we'd been using a futures contract and the basis didn't change, then we would have ended up with our price objective. Here we're using an option, the basis didn't change, and we actually get more than the price floor. We end up with 615 because the price increased more than what the premium cost us. So prices rise, we can have our cake and eat it too. We're better off. But we have protection if prices fall. So that's one strategy. The second strategy is, suppose somebody in your company says, no, we should look at the cheaper option, the one that's 575. So that's fine. Let's go through the same steps. So we pick 575. What's our floor price? Well, we plug in our numbers, our strike, minus our premium of 7 cents, minus the expected basis, so it's 538. So it's lower than with the more expensive option, correct? Up here, this was our price floor. It's now 538. So this illustrates what I was saying, that if you want more insurance, it's going to cost you more money. Yes? Okay. Just give me 1 second until I get to that line. Okay, then I'll explain it. Okay. So you're with me here, right? This is our floor price, 538. And now the price falls by 50 cents. So it goes from 620 to 570 on the futures, right? The strike was 575. Futures are now at 570. I said the time value is essentially 0. So there's a 5-cent intrinsic value because it's a put option. It's a right to sell at 575. Okay, now you can buy it back at 570. Okay? And the other one, of course, the strike was higher. It was 25. So we take 625 minus 570. Okay? I know there's a lot of numbers up on this page. So the price falls 50 cents. We do exactly the same thing. Again, we subtract the basis, the premium, which is a smaller number, and there's a bit of intrinsic value. So we end up with 538. Again, no big surprise, right? Prices fell, the basis didn't change, so you get your price floor. That's the insurance you're buying. So you end up with a lower return than if you'd purchased a more expensive option. So if prices fall by 50 cents, then you were right and your colleague was wrong, right? If prices fall by 50 cents, you want to have the expensive option because that gives you a floor of 570, and the one your colleague was promoting only gives you a floor of 538. So if prices fall, you're better off with your choice. However, so that's this possibility. Your colleague says, well, hang on, what if prices rise? So they rise by 50 cents. They go from 620 to 670. We subtract our basis and our premium. It's out of the money, right? So that gives us 633. So how does that compare? How does that look to? You make more. So was your colleague right or wrong? Depends whether the prices go up or down, right? If prices fall, you want the expensive option. That gives you a floor of 570. If prices rise, you want the cheap option. Because there we're looking at 615 on the expensive option and 633 on the cheap option. As I've said a couple of times, if prices increase, that's good because you're long cash, and so you have this opportunity gain on the cash side, and you set fire to an option that's not worth very much, so you're ahead of the game. If prices rise and you set fire to a $100 bill, it's not quite as good as setting fire to the $5 bill, right? So you're better off with the cheap option if prices rise. Which means we can't really rank the strategy in absence of information on the hedger's degree of risk aversion or in absence of information on what their price expectations are. Yes?
Based on calculated probabilities of the price increase or decrease, can you calculate like the expected value of both of them?
You could, but what does the theory of random walk tell us? The probability.
50 cents, 50 cents.
50-50, so that doesn't help us much, does it? Okay, let's graph this example. So bear with me, we're almost done. So we have a long cash position. You know how to draw that payoff chart. It's our familiar looking 45-degree line. We have the expected return here, the expected price received above or below 580 on the vertical axis, right? We buy a put option, the one we just looked at, that has a strike of 575, and the premium is 7 cents. So we're long cash. We've purchased this put. 7 cents, so the break even on that is 568. And this gives us our payoff to the put. And now you know, once you combine the put and the long cash, you've created a synthetic call option, which is the dashed line. And it's a matter of adding the put to the cash, which we've done before. You know that you look for the kink in the put, And at this price, which is 575, okay, this should be moved over slightly to the right. That should be on the kink here. You know that the premium is 7 cents. And at 575, well, we're down a nickel from 580. So we moved down this 45-degree line by 5 cents. So we're adding 5 to 7. What does that give us? A dozen, right? So we're adding 5 cents to 7. We get 12 cents. So that's our price floor relative to the 580. So it's a strike minus the premium. So 575 is a strike. The premium is 7. That's 568. We can check that. 580 minus 12 is 568. It also happens to be the break-even price. So there's a way to sort of check that you've got everything lined up here. And it looks like you've created a synthetic call. So I'd like you to label your graph accordingly when I ask you to draw a picture like this on the final exam. Okay? Yes? Okay, where does the 12 cents come from? This graph shows us the expected price that you will receive, okay, on the vertical axis here, above or below the current price. The current price is 580, okay? So that's why the cash line crosses here at 580. That's the current price. So the expected price above or below that, and you're trying to establish a floor price with the option, right? So the question is, where is that floor price? Well, we know it's the strike minus the premium because we've netted out the basis here. So the strike is 575, the premium is 7 cents, so that gives us 568. So that's one way to get the 12 cents, okay? Because it's 12 cents under 580. You see that? It's 12 cents under 580. It's always, the minus or the plus is relative to this number, 580. So that's one way to get the 12. The other way is to simply add these two payoff lines at the spot where they're kinked. And you know that this is 7 cents because that's your premium. And you're coming down the 45-degree line 5 cents. You were writing as I was talking, so I don't know if you yeah, okay. Is it clear to you now? Okay. Are there any more? Ah, finished. Isn't that amazing that we went through all those slides and we only have 15 minutes left? Let me just talk about a couple things first, okay, Montisha? So there's some housekeeping I need to take care of. I want to talk a little bit about the exam that's on the web, and then I want to talk about stock track, and then we have the evaluations to deal with. Question is the final cumulative? Yes, it is. It's cumulative. There will be more emphasis on the options than the earlier part of the course. But if you look at the final on the web, you'll see there will be some smaller questions, short answer, true, false, this kind of thing, fill in the blank, that covers the whole course. I'll ask you some questions on intrinsic value and time value. Some of you are still working that out. And then there'll be one major question that I described last week that deals with hedging. And so it's hedging with futures and then hedging with options. And it'll be like the question we just discussed, except we'll add the futures to the front end of it. Okay? So let me give you an example. And what I'll do is I just photocopy the Wall Street Journal. So if you're studying, buy the Wall Street Journal this weekend, because I'll likely make up the test early next week and I'll be using these prices. So get familiar with what's in the Wall Street Journal at the present time. You know the contracts that I always use as examples, right? What are they? Crude oil, gold, yen, euro dollar, euro, maybe cotton, maybe corn. Yeah, last year I had corn, cotton, coffee, T-bonds. Somebody, did you say T-bonds? Don't forget T-bonds. The yen. So, there's a handful of commodities that I use as examples, and those are the ones you'll see on the test. So, last year I asked this question at the end, and it's similar to what you saw in the second midterm in terms of the hedging part, right? You've now left Davis, and you're working for this company. It's called California Cotton Limited, and you trade cotton on the international markets. And somebody gave you a phone call or sent you an email asking if you'd buy some cotton for delivery in February, and you said, yes, I'll take it. So you bought this cotton, and you agreed to pay 36 cents a pound in February. And then you realize, geez, I bought this cotton, but I'm exposed to some price risk here. So are you long or short in the cash market? You're long in the cash market because you've agreed to buy it. It's not sitting in your warehouse. Okay? You can't see it. You've agreed to buy it. So you're long because you're on the hook to buy it for 36 cents. And if the price falls to 20 cents, then that new position is going to be short-lived, right? If you don't hedge it. So you're long cash. So you need to sell futures. So you sell your futures contract, and you work out the change in the basis and the final price received, and maybe the size of the contract won't exactly match the number of futures positions, but you can handle that. And so you work through that. And then I ask you to look at the options page, right, on the Wall Street. So I'll photocopy the options prices as well. So you look at the options page, and I'll ask you to choose a particular month. So maybe it's March, because this is a February contract that you've agreed to buy. So you pick the March contract, and I'll ask you to choose the one that gives you the maximum price protection. So then you have to decide which strike price you want. So you choose that strike price, okay? And it happens to be the highest strike price you see in the Wall Street because you want the maximum price protection. And, pardon? No. There's two possibilities. Okay, I'll ask you the most or the least. So then I ask you to work through the numbers in terms of what's the final price received after the hedge is initiated. You sell the cotton in February in the cash market, and of course you're reversing your futures position, and the options you either sell for the intrinsic value or throw it away, so you have to work that out. I usually set it up so the time value has gone to 0. So then you want to compare the price that you received from the futures hedge with the options hedge, right? You want to compare those two. And then finally I'll tack on a question that asks you to draw a graph, something like we just saw. So that's essentially what you'll see, okay? Yes?
For the maximum price protection on a strike price, it's the highest one. Is it also the furthest month away?
No, not necessarily. I'll give you the month, okay? Yeah. Yeah. I'm sorry, the most expensive premium, okay? Yeah, right. Okay, now Montisha has a review session a week from today, correct? Where is that, do you know? Wellman Hall. 202, at what time? 10:30 to 11:30, okay? 10:30 to 12:30, okay? Wellman Hall next week. And the exam is Saturday, late in the day. 4 o'clock, bummer. Okay, but just think how much time you have to study. That's the good part. I want to talk about StockTrack a bit. Is Peke Lee here? He's not here? Bummer. I got a surprise. Peke Lee, where are you? I know what he looks like. I don't see him. Isn't that you? What's your name? I've got a prize for you. You're famous. Anyway, the StockTrack game, the performance is better than I've ever seen. So that's wonderful. Many of you even beat the professor, right? I put on a few trades, and I think I made $10,000 or something. But is it Peke or Peke? Peke. He's sitting on $781,000. And I do have a prize for him, which is his own version of Trading Places. But the university regulations stipulate that you must answer a skill testing question before I can give you this. Okay? So I have a question for you. If we're looking at futures prices behavior over time, from day to day, how do you describe these using statistical terminology? What was the nickname of my roommate in college? The crowd can help, actually. Does that ring a bell?
Oh, random walk.
Right on. Okay. Random walk. Okay. So that describes price changes. Now, in the market, there are two groups of traders. Watch the cord. Okay. There are two groups. We classify the traders into two big groups. What are those? Right on. Okay. Speculators, hedgers. Okay. Now, when we look at the data, the hedgers are buying insurance from the speculators, right? Over time, do they pay much for that insurance? What does the meter say? No. Okay. No. Which means what? Well, if they're not paying much, are they taking money out of the market, or are they more or less breaking even in terms of their futures trading? Breaking even. Okay? So zero. Now we look at speculators, right? And I told you about the group of professionals, right? And those are the people you find on the floor of the Board of Trade. I described their pinky rings. Do you suppose they break even? Okay. Yes or no? They're professionals. They've been at it for years. Do they make money? They make money, right? They don't break even. You don't buy a ring that's worth $500,000 if you're breaking even. So then there's another group of speculators, right? And I'll characterize this group as having a little bit of knowledge, okay? So I'm in this group, and you're in this group, right? So finally, if we look at the overall market, okay, does everybody come out a winner, or how do we describe zero-sum game, right? Zero-sum. It's a zero-sum game. So if this group is breaking even, right, this group is making money, what about this group? They lose, okay? They lose because if you have no knowledge and you're trading randomly, you flip a coin, you probably break even, All right? So a little knowledge is a very dangerous thing in this market. Congratulations. Can you tell us?
How did he trade, though? We have to know his techniques.
What's that?
How did he trade?
Okay, he's got, okay. Can you answer that question, please? Oh, no. Oh, you just ruined my day.
Who lost the most?
I can't reveal that. I can't reveal that. Thank God it wasn't me. That's all I can say. Okay, I've enjoyed the class. You know what? I think we need to do the evaluations now, and then we'll have the quizzes out front. If you just come outside the building, we'll hand them back there. I'll see you next week.